Are you wanting high-speed internet but don't have access to PUD fiber? Try Sky-Fi high-speed wireless internet from LocalTel. Call 888-8888 today.
Welcome to Let's Learn here on the NCW Life channel. I'm Eric Grandstrom, your host, and on this program we dive into topics that really are all over the spectrum, from taxes to investments to death to football to baseball. I mean, a little bit of everything here on Let's Learn, and I'm no expert, so that's why I bring the experts in to help me with the conversation. And joining us today, we have Sean Patton, who is with Cordell Nair & Company. They're a certified public accountant as well as their in-house tech guru. I know you have a different title than that, but that's what I kind of like to call you.
I like that title.
I wanted to ask you that, and I don't know if we did that last year when we had you on, but how did you become kind of the in-house IT guy with the whole tax and investment portfolio company that you're working for at Cordell Nair? How did that happen?
That's a long story that could probably take up the whole show, but I actually graduated at first in IT during the boom in the early 2000s, and then the crash, I guess, really happened at the same time. But that's my original background, was in information technology, and so that was kind of a smooth as far as becoming the IT director at the firm. I'm very comfortable with information technology, and so that's kind of how all that happened.
Are you handling that for the real IT elements of the business and operations at Cordell Nair, aside from talking taxes as far as IT is concerned?
Yeah, a little, all soup to nuts. I mean, helping employees with, little issues that they might have, as well as directing the overall IT environment at our firm and where that's going. So a little bit of everything.
Well, Sean's here today to dive into a subject in our tax series tips, our tax tips series, I should say, here on the NCW Life channel, talking about retirement and planning for the future. And I know that aside from accountants and helping folks with their taxes, you guys are also investment counselors in their office as well, and can help folks with that. As we look at retirement and we look at the different portfolios that are out there and our kind of changing environments in work, as far as what employers are able to provide, what they have to provide, so we could look at this from the individual's perspective as well as the business perspective as we dive into looking at our future and setting ourselves up.
Definitely. Retirement planning has a big impact on taxes and vice versa. And that's why it's such a dual topic and something great to talk about. And a lot of great tax saving tips and vehicles actually to be used when it comes to retirement savings. One of the most popular, I guess, is the 401k plan. A lot of employees have a 401k plan at their wherever they work, and should be taking advantage of that. For the most part today, unless you're working in, certain areas, mainly for the government or other governmental type, entities, pensions don't exist much anymore. It used to be that companies set aside money for you. You didn't necessarily have to set aside money for yourself, and there would be something for you there upon retirement. More and more today, it falls upon ourselves to do that investing and planning going forward into the future, because really the dollars that we set aside today are the ones that are going to be around when we retire. So the 401k is a really great vehicle for that. For those that have that option as an employee, you're allowed to defer some of your income for tax purposes into what I call a regular deferred 401k. There is a Roth option, which we can talk about too, and that permeates through even individual retirement accounts, et cetera. That's an after-tax platform, and there's strategies and reasons for doing that as well. But most people are familiar with the regular 401k. You get a deduction for the contributions that you make into that plan during the year.
I guess the big thing to talk about first is, now that we're in 2018, have there been, I know that the tax laws changed here end of 2017, any big things that changed that we should be aware of as we prepare not only for the 2017 return, but as we're talking about investing in our future and planning for retirement? what kind of changes came about that might be impacting us as far as our retirement packages and whatever portfolio we may have.
Yeah, not a lot of changes happened. There were some things that were originally talked about, in the media that you might have heard about, big things that were being, pitched. At the end of the day, we pretty much have all the same options that we have before. Okay. It's just that those limits might be a little bit higher. So for instance, with the 401k plan we were just talking about, you can defer up to $18,000 in 2017, of your own money. Right. As well as if you're over 50, you can put in an additional 6 for a total of $24,000. In 2018, you can do $18,500. And then if you're over 50, another $6,000. So really the same type of plan, the same options. You have the ability to defer another $500 into that plan between 2017 and 2018.
Okay, so not a big shift.
Not huge shifts.
Okay,
Yep.
All right. Anything else that trips the radar as far as the changes are concerned? I know we had some of your folks from the office come in, and as far as returns are concerned, there is a big difference, especially if it comes from the employer's perspective as we step into the future. Anything else that as far as retirement planning? That's not much of a change as far as our being able to write off the investment in the 401k. Anything else? Well,
that actually could have an impact. And we'll just go to the corporate tax rate change that happened moving from 2017 to 2018. We had a corporate tax structure that went up pretty high as far as the income tax effect. That's now at a flat tax rate of 21% into 2018 going forward through 2025. So with that flat tax, if your business now has a lower tax burden than it did before, it's quite possible that there might be some more incentives that they might be giving out. You've heard in the news probably, employees are getting bonuses and things like this as a result of this tax savings, which is great for employees, great for the economy, et cetera. As a part of that, typically, if we go to the 401k plan, a lot of those plans have a match. Where if you put in a certain amount of dollars into the plan, your employer is going to match you up to a certain amount. Well, it's quite feasible with this reduction in corporate tax going forward. You could see some increasing match percentages, possibly, right, as an additional employee benefit. So maybe instead of putting, for every $1,000, up to $1,000 you put in, you get maybe $250. Maybe they lift that number to $350. Well, we always encourage employees that have a 401k plan or similar plan available to them that they at least put in enough money to get that max match from the employer, because that's really free money and is going to be there. I can't say free, I guess. Nothing's free. Yeah. It does come with a tax burden on down the road, but at the same time, that's more dollars that are going to be there for you in retirement, so you got to take advantage of that.
Okay. 3 different areas. We'll get into this after the commercial break. Taxable, tax deferred, non-tax, as far as retirement planning is concerned. So we'll do that when we come back from the break. It is Tax Tips, all part of Let's Learn on the NCW Live channel. We'll be right back.
Stay up to date with what's happening in North Central Washington. Go to the NCW Life Community Calendar at ncwlife.com.
Welcome back to Let's Learn here on the NCW Life channel. I'm Eric Granstrom, joined by Sean Patton from Cordell Nairn Company, talking about retirement and planning for your future. And as far as your taxes are concerned, that's, of course, they're all linked together. It's all part of the same pie. And just how much of the pie do you get? How much of the pie do the feds get? How much of the pie does somebody else get? So, I've learned a little in this course of this program, talking with you folks, talking with some other investment counselors and such. As far as wise investments to make, also depending on what your goals are individually, how old you are when you start getting into this, how aggressive you'd like to be, and what type of investments you'd like to make, and whether you want to pay the tax now, you want to pay the tax later, or you try not to pay any tax at all. So let's dive into those different topics here, Sean.
You bet. You're going to pay some tax, no matter what, when you're getting a benefit, regardless of what type of plan, you're putting your money into. But you're really choosing on whether you want to pay tax today or tax later. And if you're paying tax today, there is a tax-free component. We don't say free very often, but there really is a tax-free component to that type of vehicle, the Roth type investment vehicle, to where when you make an investment, if you're paying tax on that today, the earnings on those dollars can be tax-free if you leave them in that vehicle, for retirement. Again, has the same, can have the same penalties for taking those out, before 59 and a half, et cetera. We all are aware of some of those issues with our retirement portfolios. They're there for the long term, and that's what, if we're going to put money into them, they should be treated that way. As you mentioned, depending on your time horizon, your age, you might have a different risk tolerance as far as the investments that you make, how aggressive you might be in that vehicle. But if you have a lot of time, you have potential to ride through any market cycle. Market cycles tend to be, 5 to 10 years. Those are getting longer, as we've seen more recently. But generally, if you have a number of years before retirement, you have a chance to have a little bit more growth in there, because you don't need all those dollars. That's one important thing to remember. When you retire, you don't need every single one of those dollars all at once. Right. You're going to take some of that out over time in order to support your lifestyle.
And that's the smartest way to do it too, is because you're not, you try to take that all at once, you're going to get a big tax hit right there on the button.
Right, exactly. With that traditional 401k we were talking about, or even a traditional IRA, whatever vehicle you have or are using, if you've put money in and taken a tax deduction for that today, not only is the earnings on that taxable in the future, but also the portion that you put in, because we got a deduction for that today, we're going to have to pay tax on that tomorrow. Right. So that is an important distinction. And with those traditional type accounts, you are going to be mandated to start taking money out of those accounts at 70 and a half. So we can't hold on to it forever. The IRS says, okay, that's been long enough. We're going to have to start taking money out of this portfolio now, and it's going to be taxable to you. Another one of the great advantages, actually, of a Roth type plan is that there is no minimum distribution requirement at this time. So at 70 and a half, there's no requirement for you to withdraw money, partly because there's no tax on those dollars. You've already paid them, and assuming you've left it in, you don't have any tax on the income either. So the IRS isn't mandating that you take out of those vehicles.
With the change in the tax laws, was there a threshold change as far as the amount of income that's taxable off of those retirement accounts once you start drawing on those, or are those levels still where they've been over the last several years?
Well, those are when you withdraw out of a traditional type account where you've taken a deduction at the time you made the contribution. Whenever we start to distribute those dollars in the future, those have always been taxed at ordinary income rates. Okay, but with the recent tax law changes going into 2018 here through 2025, those ordinary income rates were lowered. And so there would be a benefit, of, for example, if you were able, took money out in 2017, your ordinary income rate may be a little higher than it is in 2018. So even though, we got different rules, our old adage, even towards the end of 2017, really didn't change that, as a taxpayer, we're still looking to defer income right into the future and accelerate deductions. And so that, that didn't even change going into 2018, even though we had, one of the most significant tax law changes in 3 decades.
The paperwork, and I say paperwork anymore, we're electronic it seems now, even on the returns. It's you have this and you put it in your file and that's it. The electronic version of that goes off to the IRS. But the paperwork we're getting as far as these investments and tracking it all, anything changing on that, or are we still the same on what we should have got it in the mail already for 2017, and as we plan for the future here for 2018 and through this next cycle till, what did you say, 2025?
2025. This tax cut does sunset for individuals at that time, and so part of the budget requirements of the tax law passage that it couldn't go on forever. And so, but as far as the paperwork goes with respect to investments, really no changes there. You know, if you have a taxable investment account, you're still going to get the same 1099. You may or may not have received that at this time. As we all know, depending on the types of investments that are in those accounts, you might get your 1099 early, or it could be pushing up towards the deadline.
Right.
And that all really depends. It's not the broker necessarily that you're with, because they're waiting for information from specific investments in order to report that to you. So there's a lot of work that goes on behind the scenes to get that to you. So it's not always early in the season we receive those.
We talked in a previous episode about this whole new technology, this Bitcoin conversation. Are people using that as a retirement investment?
Yeah, good question, and I'll get to that in a second. The ability to invest into a retirement account is not only through a company 401k type policy, right? There are individual retirement accounts out there that you can get if you don't have that benefit at work or an option with another plan. Don't forget that there are individual retirement accounts. Okay, the limits are a lot smaller, the benefits aren't quite as rich, but we still can get a tax deduction today, or invest in a Roth type individual IRA, pay tax on those dollars, not get a deduction, and be able to take those out tax-free later. So you do have those options. The limits are a lot less, as I mentioned, $5,500 plus an additional $1,000 if you're over 50 years old.
Okay.
But the lead in there is that you need an individual type IRA account to possibly be able to make a virtual currency investment in your retirement account. Okay. And I don't know of any 401k platforms at this time that are going to make you make that speculative investment in them. So in order to hold something like that, there is what's called a self-directed IRA. Takes a specific custodian to do that, to be able to hold non-traditional assets inside of an IRA. Okay, so typically these are not new. Investors have used these, for a number of years to hold real estate or something else that just isn't your vanilla stocks and bonds, so to speak, that the IRS easily allows within 401ks and IRAs. So you need a specific custodian that'll allow you to hold that. As far as whether or not that's allowed with virtual currency is a great question. And I'll answer it this way. From the rules that are out there, it's not specifically prohibited. Okay? And generally, if it's not specifically prohibited, then it may be allowed. But there's no specific information out there from the IRS that says that it is. But if we look at the type of investment, as we go back to our Bitcoin speech and other virtual currency shows that are going to be on as well, is that this is a capital transaction. The IRS is treating this like property or an investment, very similar to stocks and bonds if we were going to invest in something. So, from that standpoint, it seems logical that they could allow it if they're going to treat it like this and not as a coin, because there are investing in certain coins within an IRA is specifically prohibited. We can't actually hold those. Some you can. There's varying degrees and rules, but they would be held in the same self-directed IRA type account. But as far as the way the IRS is treating it, they're not treating it like coins. They're treating it like property or capital, just like our stocks and bonds. So from that standpoint, it could be doable, and people today are investing in those self-directed IRAs in virtual currencies. Not recommending it, but that's not a recommendation, but
rolling the dice.
It is possible.
We're going to take a break and come back with a final word with Sean Patton from Cordell and Aaron Company here on Tax Tips on the NCW Live channel. Stay right there.
Is your vehicle in need of a quick oil change or tune-up before hitting the road this summer? Stop by Quick Lube and Tune, the home of the good guys at 610 South Wenatchee Avenue.
Welcome back to Let's Learn on the NCW Life Channel. I'm Eric Granstrom, and we continue our tax tips with Sean Patton, Cordell Nair and Company, joining us here. Sean, we're talking about retirement and looking towards the future and trying to invest but not give so much to Uncle Sam, possibly. Anything I can do today that I can maybe, retirement seems such a long-reaching goal. Anything I can have short term that's not going to have maybe a negative impact on me, or?
Well, yeah, any investment that you make today is going to help you out short term. We talked about whether it was the 401k plan or employer sponsored plan or an individual retirement account. We can take a deduction today, which is going to help us on our tax return right now.
Right.
In fact, a great tip for viewers is that one of the only areas that you can actually get a deduction for last year by doing something today is through an investment type vehicle like an IRA. Or even a health savings account. Many of us don't think of health savings accounts, which are tied to our high deductible health plans for medical purposes. We don't think of them as an investment vehicle, but they can be. And with the individual IRA and an HSA, you can actually make a contribution up through the due date of the tax return. Okay, April 15, or this year, April 17, because the holidays, et cetera. You can actually make a contribution into those types of accounts for 2017 in 2018 and take that deduction on your 2017 return. You don't have that option if you're an employee inside of a 401k. You need to get those investments in before the end of the year.
Okay.
And so that's one of the areas that, even though the year's gone by, you can calculate your tax return, get everything in there, and then figure out, hey, would it be worthwhile for me to maybe make my $5,000, $5,500 investment, let's say, into my individual IRA? How much tax is that going to save me? Or should I make a contribution into my health savings account, which would give me that deduction as well?
With the health savings account, this is a new conversation that I haven't had before. What are the limits? Are we talking $5,500 there too, or what are the breakoffs?
Actually, it can be a little bit more, but different than the retirement accounts. Individual retirement accounts are individual. They're yours and mine. They're not shared. With an HSA plan, with this high deductible health plan, you can actually have a single or family coverage with those policies, and depending on what you have there, you can actually invest up to different limits. Okay, so if you have the family policy for 2017, you could invest up to $6,750 into that account. If you were an individual, you're going to be looking at about half that, $3,350, to be able to make that investment. So it depends on what type of coverage you have as to whether you're covering your whole family or you're covering yourself.
Okay. But is this new? I mean, I've not heard of any time where you could do something in the new year to benefit yourself. It was all the rush before December 31st.
No, this is not new. This has been around, for a while. And if you are, even if you're self-employed, there's different. We didn't talk about those retirement plans, but there are different options out there. If you're self-employed, you have up until a lot of times the due date of your tax return, plus even extensions. That doesn't exist with the individual IRA and the HSA, but there are some. What's called a SEP, a simplified employee pension, or a solo 401k for people that are working on their own in their own business. If they have those types of plans, they can actually go all the way out through the extension deadline to make those contributions.
Interesting.
That's there really because in order to truly understand the tax impact of what that investment might have, we need time to be able to get the information and prepare our return. And so it's very helpful that's allowed to go past year end and have a little bit of time to make that computation and then say, hey, is it worthwhile for me to make this type of investment? But once those deadlines are gone, right, we've passed another year and we can't make that investment into that vehicle for that year. And so, as we talked about, it's really up to us to make those investments for our own retirement. So,
phone number real quick.
Phone number 509-663-1661.
Sean Patton, I'm Eric Granstrom. That's Let's Learn on the NCW Life Channel. Thanks for watching.
For all the latest news in North Central Washington, go to ncwlife.com or find us on Facebook. Got a news tip? Email us at news@ncwlife.com or call 888-2020.